If you own gold or silver right now, do not close this video, because this week something happened in the market that most channels are not explaining properly. And if you get this wrong, you could end up selling at exactly the wrong moment. Gold briefly slipped under $4,000 this week for the first time in a while, and silver had one of its worst weekly closes in months. Everyone is calling this bad news. I am going to show you why this drop is actually one of the best setups we have seen in a long time. And I am going to explain the one number buried in this week's inflation data that almost nobody is talking about, but it changes everything. Stay till the end, because that number alone could shape how you plan your next few months in this market. Quick reminder before we continue. This channel is 100% dedicated to gold and silver. Nothing else, no distractions. If that is the kind of straight-to-the-point market update you want in your feed every day, hit subscribe and turn on notifications so you don't miss the next breakdown. And I want to hear from you in the comments. After this week's drop, are you buying more, holding steady, or staying cautious? Tell me honestly, because your comments genuinely shape what I cover next on this channel. I am your analyst here at Metal Market News, and every single day I go through spot prices, mining stock movement, bond yields, and Federal Reserve testimony, so you get a clean, no-noise summary instead of having to dig through hours of financial news yourself. Today's topic is this week's pullback in gold and silver, why it happened, and more importantly, what it is quietly telling us about where this market goes next. Let's start with the actual numbers from this week's close. Gold finished the week down about 1%, closing at $4,017.30 per ounce. During the week, gold actually dipped below the $4,000 mark on a couple of trading days, but importantly, it did not close the week below that level, which matters a lot technically. Silver had a much rougher week, down 4%, closing at $55.83 per ounce, which is one of its lowest weekly closes in quite some time. Mining stocks moved in the same direction. The major gold miners index dropped close to 4% on the week, and junior gold miners dropped nearly 5%. So across the board, metals and mining stocks took a hit this week, and we need to understand exactly why before deciding what it means going forward. To understand this week's move, we need some background on what has been happening across the whole market, not just in gold and silver. This has been a rough week for risk assets in general. The broader stock market finished lower, and it was actually tech and AI-related names leading the decline. There are growing signs that some of the excitement around AI stocks may be cooling off. One of the clearest examples is a major recent tech IPO that priced around $135 a share, spiked as high as $225 within days, and has since fallen back down near $124, meaning anyone who bought at the peak is now down roughly 45%. Streaming and media stocks also had a hard week, with one major streaming company dropping around 8% after disappointing earnings, as household budgets everywhere continue feeling squeezed by rising costs. This matters for our topic because it shows a broader shift in sentiment. Investors who were chasing high risk, high momentum trades are pulling back and de-risking across the board, and unfortunately silver, being a smaller and more speculative market than gold, sometimes gets pulled down in that same wave of selling even though its own fundamentals haven't really changed. At the same time, the bigger and more important background story is what's happening with bonds and the Federal Reserve. Long-term interest rates have been climbing, with the 10-year Treasury yield closing the week around 4.54% and the 30-year around 5.06%. These are some of the highest yields we've seen in years. Rising yields tend to pressure gold and silver because these metals don't pay any interest, so when safer government bonds start offering higher returns, some money naturally rotates out of metals and into bonds. Layered on top of that, we had testimony this week from a senior Federal Reserve official in front of the Senate, and this is genuinely significant. It was directly admitted that recent inflation was caused by monetary policy decisions. In plain terms, an actual Fed official openly acknowledged the central bank's role in creating the inflation problem, rather than blaming outside factors like global supply chains or geopolitics. When asked what the Fed plans to do about it, the response mostly amounted to committing to talk seriously about fighting inflation and reviewing their policy tools, without laying out a firm, specific action plan. Markets read that combination, an admission of responsibility paired with no concrete new action, as a signal that interest rates could stay elevated for a while longer, and that hawkish tone weighed on both gold and silver through the week. Now here's the real problem, and this is the part most headlines are getting completely backwards. On the surface, this week's official inflation numbers looked encouraging. Producer prices came in cooler than expected, and that helped bond yields ease slightly, which is part of why the market found some stability late in the week. But if you actually dig into why those numbers looked soft, the picture changes fast. The main reason producer and consumer prices looked cooler was a sharp decline in oil prices during June. The problem is, oil has already reversed hard. Crude prices jumped over 11% in just this past week alone and are now up more than 20% for the month of July after falling sharply in June. So the good inflation data everybody celebrated was largely built on an oil price drop that has already unwound. That is a serious problem, because it means the next round of inflation data could easily come in hotter again. There's an even bigger warning sign hiding in this week's trade data that barely got any media attention. Import prices were up about 7% year over year, but export prices, which reflect the cost of goods actually produced inside the country, were up over 10% year over year. Compare that to the official headline inflation number, which was sitting far lower, around 3.5%. That is a meaningful gap. It suggests that real, on-the-ground price pressure inside the domestic economy is running noticeably hotter than the official inflation figures are showing, because production costs at home are rising faster than the cost of what's imported from abroad. In simple terms, the inflation problem may genuinely be worse than the headline numbers suggest, and that undercuts the market's recent optimism about rates coming down anytime soon. On top of all that, geopolitical tension escalated again this week, contributing directly to that jump in oil prices. Historically, rising conflict and war tension is supportive for gold because investors run towards safe haven assets during instability. But this time, something unusual happened. The market treated the war-driven spike in oil prices mainly as an inflation risk, meaning it increases the odds the Fed keeps rates higher for longer, and that fear temporarily outweighed the normal safe haven demand for gold. So paradoxically, the same war news that should help gold ended up adding short-term pressure instead, simply because traders were more focused on interest rate consequences than on safety demand. This mismatch between the underlying macro picture, real inflation likely running hotter, oil rising again, war tension increasing, and gold's short-term dip is exactly the kind of disconnect that experienced metals traders watch closely, because it rarely lasts long before the fundamentals reassert themselves. Let's break this down further and look at the actual technical picture, because this is where the real opportunity shows up. Yes, silver closing the week near $55.83 feels like a big drop when you remember it touched an all-time high above $121 earlier this year. But zoom out for a second. Silver is still trading comfortably above $50, which for decades was an almost impossible ceiling. Silver only approached that $50 level twice in all of history before this year, once in 1980 and once in 2011, and both times it failed and crashed hard. This year, silver didn't just touch $50, it broke straight through it and kept climbing before this recent pullback. Holding above that historic $50 zone, even after a rough week, is a genuinely strong technical signal. In my view, a few years from now, this dip from $121 down into the mid-50s may look like a small pause on a much bigger chart rather than the end of the story. There's also an interesting credibility angle worth analyzing this week. A senior US Treasury official was recorded telling a television host that old, pre-1968 silver certificates could still be physically redeemed for real silver coins at the government's gold depository. That statement is simply not accurate. Those notes stopped being redeemable for precious metal decades ago, first for gold certificates back in the 1930s, and then for silver certificates in 1968. Whatever the reason behind the mistake, this kind of mix-up from someone at that level raises a fair question among precious metals investors about how closely official statements on gold reserves should be taken at face value, and it's the kind of story that tends to fuel more interest in physical metal ownership rather than paper promises. One more current events angle worth understanding, because it directly affects how fast news moves markets. There's been growing use of official social media posts from top political figures to move markets in real time. Announcements on tariffs, trade deals, or conflict developments can swing oil, stocks, and metals within minutes of being posted. This means that gold and silver traders increasingly need to watch not just economic data releases, but also political and social media developments happening in real time, because a single unexpected post can trigger sharp short-term volatility in precious metals prices, even when nothing about the underlying supply and demand picture has actually changed. This is part of why we're seeing sharper, faster swings in metals than we used to see even a few years ago. Information, true or not, moves instantly, and price reacts instantly with it. So here's my honest prediction, based on everything we've covered today. I don't believe this week's pullback changes the bigger picture for gold and silver. I think it's a shakeout, not a trend reversal. The reason official inflation numbers looked soft this week was largely due to a temporary drop in oil prices that has already reversed sharply in July, and the deeper trade data shows real domestic price pressure running hotter than the headline numbers admit. That combination, sticky underlying inflation, rising oil, elevated bond yields, and a Fed that has now openly admitted its own role in creating the inflation problem without offering a firm new plan, is, if anything, a bullish long-term setup for gold and silver, even if it causes short-term choppiness like we saw this week. For gold, I'll be watching closely to see whether it can hold above the $4,000 level on a weekly closing basis going forward. Holding that level despite touching below it intraday is a good sign of underlying strength. For silver, the key level to watch is that $50 zone we talked about. As long as silver holds above it, I see this more as a healthy reset after an extremely fast run-up earlier this year, rather than the start of a bigger breakdown. If oil prices keep climbing and next month's inflation data comes in hotter, which the trade numbers suggest is likely, I would expect renewed buying interest to come back into both metals fairly quickly. I want to be completely transparent with you. This is my personal read on verified, latest available data as of this week's market close, but gold and silver prices move by the minute. So please check a live spot price before making any trading decision, and always do your own research. I am not a licensed financial advisor, just an analyst sharing data and my own honest interpretation of it. And any decision you make with your money is entirely your responsibility. If this breakdown helped you see this week's pullback with more clarity instead of panic, that's exactly why this channel exists. Hit subscribe if you're not already part of the family here, smash that like button so more serious investors find this channel instead of hype pages, and tell me in the comments. Are you using this dip to add more silver, more gold, or are you staying patient on the sidelines? I read every comment. See you in the next episode, right here on Metal Market News.